The silver market is experiencing a period of unusual instability, and its effects are no longer confined to charts, futures prices, or online trading platforms. The strain is now visible at the local level inside coin shops, bullion counters, and dealer networks that usually operate with predictable rhythms. What makes this moment stand out is not just price movement, but operational disruption. Dealers are adjusting their behavior in ways rarely seen under normal market conditions. One incident illustrates the severity of this shift. A local silver dealer made a sudden decision to stop selling silver entirely, not because inventory had run out and not due to a pricing error, but because of a cash shortage. The halt was immediate. Sales were paused to prevent further imbalance between incoming and outgoing funds. The decision was made quickly, based solely on the shop's internal financial position, without coordination or knowledge of other dealers' actions. What makes this episode even more notable is that the dealer herself was surprised by the necessity of this move. It was not part of a pre-planned policy or a seasonal adjustment. It was a defensive response to tightening liquidity conditions. Only later did it become clear that similar warning signals were appearing across the dealer landscape, indicating that the problem was not isolated but systemic. This moment serves as a lens into a broader pattern emerging across the silver trade. Local and regional dealers, typically resilient and accustomed to fluctuating demand, are now encountering conditions that force rapid operational changes. The situation reflects a market environment in which liquidity, not price alone, has become the central pressure point. The result is a silver marketplace behaving in ways even experienced participants describe as highly unusual, with dealer behavior shifting from routine transactional flow to defensive positioning. This instability is not limited to a single shop or region. The same pressures affecting one local dealer are appearing across neighborhood coin shops and major online bullion retailers alike. What is emerging is a synchronized stress pattern across multiple layers of the retail silver market, where businesses that normally operate independently are responding in similar ways to tightened financial conditions and unpredictable transaction flow. Local coin shops and online dealers differ in scale, inventory systems, and customer reach. Under ordinary circumstances, disruptions tend to affect one segment more than another. In the current environment, however, volatility is hitting both channels at once. Dealers are facing rapid swings in customer behavior, irregular order sizes, and cash pressure that complicates normal buying and selling operations. The result is a marketplace where availability, pricing, and execution speed can vary dramatically from one hour to the next. The volatility is driven not by heavy buying or selling alone, but by both occurring at elevated levels simultaneously. Dealers are encountering customers eager to purchase physical silver at rising premiums, while also seeing waves of sellers attempting to liquidate holdings. This two-sided pressure creates operational imbalance. Shops must manage outgoing cash for purchases while also securing enough inventory to fulfill sales, all under compressed timeframes. Even larger online dealers, despite more robust infrastructure, are not insulated from these stresses. Higher transaction volumes can amplify liquidity demands rather than reduce them. Large order pipelines, settlement timing, and supplier coordination all become more challenging when market behavior accelerates beyond normal patterns. Taken together, these conditions describe a retail silver market operating under stress rather than routine fluctuation. The shared response across small and large dealers alike indicates that the volatility is structural, affecting the mechanics of trade, not just the quoted price of silver. A key factor behind these disruptions is a growing shortage of available cash among dealers. Liquidity, the ability to pay sellers promptly while continuing to fund new inventory, has become constrained across many parts of the silver trade. Dealers who normally stand ready to buy are finding that their immediate cash reserves are no longer sufficient to maintain normal purchase volumes. This constraint is reshaping how transactions are conducted at the counter. This problem is not limited to small operations. Larger organizations are also facing funding pressure, leading to slower purchase processing and tighter limits on the amounts they are willing or able to acquire at one time. In some cases, payments that were previously immediate have been delayed. This represents a significant departure from normal dealer behavior, where fast cash settlement is a core feature. One unusual response to these liquidity constraints has been the use of promissory notes. Instead of paying sellers immediately, some dealers issue written commitments to pay at a later date. This allows them to secure incoming silver without exhausting available cash, but it also signals that transaction flow has outpaced ready liquidity. Such measures are rarely seen under routine bullion market conditions and typically appear only under stress. These promissory arrangements alter the risk profile for both sides. Sellers must decide whether to accept delayed payment, while dealers must carefully manage future obligations against uncertain incoming funds. This adds friction to what would normally be a straightforward exchange of silver for cash. These liquidity pressures explain why some dealers have reduced purchases, paused sales, or imposed stricter transaction limits. The constraint is not demand alone, but cash availability, and that constraint is reshaping retail silver trade. Another pressure point is the difficulty of liquidating large format silver holdings. Bigger bars, especially kilo-sized pieces, are significantly harder for dealers to absorb than smaller units. The challenge is not related to purity or authenticity, but to transaction size and capital commitment. Each large bar represents a substantial outlay for the buyer, and in a liquidity-constrained market, that outlay becomes difficult to justify and execute. Dealers with limited cash reserves must prioritize flexibility. Smaller items allow them to spread risk across multiple transactions and maintain more balanced cash flow. Large bars concentrate too much value in a single purchase, tying up funds needed to handle smaller trades throughout the day, even when dealers are willing to buy. Silver, they may decline or heavily discount large bars simply because of the capital required under current conditions. This creates a mismatch between what sellers hold and what dealers are prepared to purchase. Owners of large bars may expect straightforward liquidation but encounter hesitation or reduced offers. The barrier is not lack of interest in silver itself, it is the scale of the transaction relative to available liquidity. The situation also slows turnover. Large bars cannot always be quickly moved to the next buyer, further discouraging acquisition. When resale speed is uncertain, capital remains tied up longer, adding operational risk. In this environment, size is a liability. The larger the unit, the harder it is for dealers to absorb it, reinforcing the market's preference for smaller, more manageable transactions. Even when dealer buying continues, it is happening at sharply reduced scale, transactions that would normally be routine moderate bulk purchases. Collection buyouts or estate-level acquisitions are being postponed or declined. Instead, purchases that do occur are typically small. Dealers are choosing to conserve cash and maintain flexibility rather than commit large sums. This shift toward microtransaction behavior reflects defensive cash management. By restricting purchase size, dealers can continue participating in the market without overextending limited liquidity. Small purchases allow inventory to flow while preserving the ability to respond to customer sales throughout the day. It is a controlled intake strategy designed for uncertain conditions. One consequence is the suspension of estate-level purchases. Normally, coin shops and bullion dealers compete to acquire sizable collections from estates or long-term holders. These require substantial upfront cash and confidence in resale timing. In the current environment, that confidence is reduced. The capital required is too large, and resale timelines too unpredictable for many dealers to proceed. As a result, sellers with large collections may find fewer buyers willing to transact all at once. Transactions may be broken into smaller batches or delayed entirely. This slows overall market circulation and increases friction between supply and dealer capacity. Dealer participation hasn't disappeared, but it has narrowed. Buying continues, but in measured, tightly controlled amounts, prioritizing operational stability over volume. These financial pressures are also reshaping how coin shops operate daily. Store hours, staffing patterns, and customer access are being adjusted to cope with backlogs, inventory strain, and cash limitations. Rather than maintaining standard schedules, some shops are closing earlier or reducing the number of days they operate each week. These changes are operational responses to workload and financial stress, not cosmetic adjustments. Processing has become more complex and time-consuming. Dealers must carefully track incoming silver, pending payments, delayed settlements, and outstanding orders. When transaction volume surges on both buy and sell sides, administrative load increases sharply. Reduced public hours give staff more time to reconcile accounts, manage inventory, and coordinate supplier relationships without constant counter-traffic. Fulfilling existing orders has also become a priority. With supply chain strain and slower wholesale turnaround, shops must focus on commitments already made. Pausing or limiting new transactions ensures prior obligations are met. Inventory handling practices are also tightening, with careful monitoring and selective acceptance of products. Operational caution replaces routine throughput, prioritizing stability. In some, shorter hours and fewer open days signal a market under operational stress. Shops are not simply responding to price volatility. They are restructuring daily workflows to remain functional under unusual transactional pressure. The pressure is not limited to retail. Stress extends upstream to wholesalers and larger distributors, who provide the flow of products that allows local shops to restock efficiently. Under current conditions, that flow has slowed and become less predictable, creating ripple effects throughout the network. When wholesalers face funding pressure and high transaction volume simultaneously, order processing declines, delivery timelines stretch, product availability fluctuates, and confirmation speeds slow. Local dealers dependent on quick restocking find replacement inventory delayed, complicating pricing and sales commitments. Upstream strain forces local shops to operate cautiously, without reliable restocking. Each sale carries risk, as replacing inventory may not be immediate. Processing delays at the wholesale level also interfere with transaction matching. Dealers buying from the public often offset purchases through wholesale channels when that slows. Silver accumulates on dealer books longer than expected, tying up capital and storage. The result is a layered slowdown. Both downstream and upstream channels operate with reduced speed and flexibility. Meanwhile, the market is experiencing an unusual surge of activity in both directions, heavy buying and heavy selling simultaneously. This dual-sided demand is not typical. In more stable periods, one side dominates. Currently, both forces are active, creating price distortion and transactional imbalance. High buying interest is pushing purchase premiums higher. Buyers seeking physical silver encounter elevated markups, as dealers price defensively to account for replacement uncertainty, wholesale delays, and liquidity risk. At the same time, sellers find liquidation offers significantly lower than expected. This produces a painful spread, expensive to buy, costly to sell. The gap reflects operational stress rather than intrinsic value differences. The coexistence of strong buying and selling increases volatility within shops. Prices must be adjusted frequently, sometimes multiple times per day, as dealers react to order flow and liquidity position. This intensity is unprecedented, stretching dealer capacity, contributing to liquidity shortages, operational adjustments, and selective transaction limits. One segment of the market stands out: constitutional silver circulation coins like half dollars, quarters, and dimes containing silver. Despite familiarity and fractional flexibility, these coins are currently receiving reduced interest from dealers and refiners. Demand has cooled compared to other silver formats. The hesitation is not about metal content but about handling and resale efficiency. Processing constitutional coins requires sorting, counting, and batching, which adds friction when operational simplicity is prioritized. For this reason, these coins are described as unloved at this time. Sellers may encounter weaker offers or less urgency compared to other silver forms. However, this lack of trade-side enthusiasm creates opportunity for buyers. Because constitutional silver is currently unloved, it can often be acquired below spot price. The factors that make dealers hesitant: extra handling, sorting, and processing reduce market competition, creating a window to acquire silver on favorable terms. For collectors, investors, or anyone seeking physical silver exposure, this segment represents a strategic entry point. Small denomination coins, normally circulating in secondary markets, now hold added value for those willing to manage minor logistical considerations. Current market stress has temporarily shifted scarcity and pricing dynamics, turning what is usually a routine category into an opportunity. These conditions show how volatility can reshape perceptions of value within the silver market. While other products carry high premiums and constrained liquidity, constitutional silver offers accessibility and price flexibility. Overlooked segments can act as a counterbalance to expensive mainstream bullion, allowing buyers to maintain silver exposure without extreme premiums. In conclusion, the combination of operational strain, liquidity shortages, and selective dealer behavior has reshaped the retail silver landscape. For those paying attention to market signals, constitutional silver represents a segment of opportunity, a chance to acquire physical silver below spot in a period defined by unusually high transactional and pricing volatility.